Interest rates and inflation drive a currency's exchange rate. When combined, both signify a country's relative level of economic health. Currency exchange rates play a vital role for commercial trade activities. Because of that importance, exchange rates are the most watched, analyzed, and governmentally manipulated economic measures. Currency exchange rates are also important at the business operations level, as they impact the real return of an investor's portfolio. We will discover some of the major forces behind exchange rate oscillations. In this chapter, we will explore the factors that underlie currency value movements. These factors include market fundamentals and market expectations. We will experiment with the determinants of the exchange rate fluctuations as behaving different in the short run versus the long run. Although exchange rate overshooting can persist for significant periods, fundamental forces tend to push the currency back to its long-run equilibrium path. We begin by considering how exchange rates are determined in the long run by studying relative productivity levels, relative price levels, consumer preferences for domestic or foreign goods, and trade barriers such as tariffs and quotas. Individually, these factors give certain insight to the end result of exchange rate determinations, but when taken together, a clearer picture of their synergistic effect is formed. According to the Purchasing-Power-Parity approach, changes in relative price levels determine exchange rate fluctuations over the long run. A currency maintains its purchasing power parity if it depreciates by an amount equal to the excess of domestic inflation over foreign inflation. In the short run, decisions as to which assets, domestic or foreign, are more preferable to hold play a primary role in exchange rate fluctuations. According to the asset market approach to exchange rate determination, investors consider two key factors when deciding between domestic and foreign investments: relative interest rates and expected changes in exchange rates. Modifications of these factors result in exchange rate fluctuations that we observe in short-run trends. Another factor influencing exchange rates is the phenomenon of exchange rate overshooting. An exchange rate is said to overshoot when its short-run response to a change in market fundamentals is greater than its actual long-run response. Finally, we will consider the methods that currency forecasters use to predict exchange rate movements as judgmental forecasts, technical analysis, and fundamental analysis. As I said earlier, we should treat currencies as a commodity. With that approach in mind, it is reasonable to apply the supply and demand principle to identify forces determining a currency's equilibrium value. Unfortunately, that is where the ease of price forecasting ends. The factors influencing supply and demand are unique when applied to such a specific commodity as money. These factors representing economic variables fall into the category of market fundamentals. They range from productivity and inflation rates to consumer preferences and government trade policies of the subject nation and all of its major trading partners. Market expectations are associated with the human factor. When multiple nations are involved in currency transactions, a substantial amount of individual forecaster expectations influence decision-making choices. Forecast horizons for exchange rate changes express a time interval expected forecasts will be realized within. These are highly variable and are grouped as short-term speculative, lasting a few days or weeks, medium-run cyclical, lasting a few months, to long-run structural, lasting from 1 to 5 years. Often, it happens that a long-run or even a medium-run forecast will be adverse to the short-term forecast, but this is not an indication of forecast errors. Often, spot exchange rates between currencies will counter-react to economic policies enacted for the long-term growth, or to changing economic activities enacted for midterm goals. It is common for these forecasts to differ in their specificity, with the shortest-term predictions focusing on specific rate estimates, broadening for the medium-run predictions to be seen within a range of values. The longest-run predictions are necessarily viewed as a trend line type of forecast, indicating the direction of anticipated trends. Some of the more advanced long-term predictions depart from the straight-line forecasts to make predictions of future value moderating return to general baseline conditions. Long-run exchange rate predictions are based on a variety of macroeconomic forces such as relative price levels, productivity levels, consumer preferences for foreign or domestic goods, and trade barriers. Because of the interactive nature of these factors, a change in one variable in a positive direction can be offset by a counter-moving value for an associated variable. Domestic productivity may increase while trade barriers increase, and the offsetting effect on the domestic currency exchange rate may remain unchanged. The relative effects of each category of change are not uniform for the domestic currency, but when interactions with exchange rates for other currencies are considered, the offsetting factors require counteracting balances. For example, we can consider the exchange of US dollars and British pounds while evaluating the effects of relative price levels, productivity levels, country of origin preferences, and effects of trade barriers. We look into each category of change to explore the impacts. Domestic price levels are an indicator many domestic firms use as a barometer of acting economic forces while making daily business decisions. It is the information first made available to most analysts. We may consider the effect of domestic prices rapidly climbing in the U.S. while they remain stable in the United Kingdom. This results in an increase for imported goods from the UK because of the price comparative advantage. This in turn increases the demand for UK pounds purchased by US companies so they can import more UK-made goods. At the same time, the US-made goods are priced relatively higher in the UK, making the supply of pounds decrease. The increase in the demand for pounds, met with a decrease in supply for pounds, establishes a new equilibrium intersection of the supply and demand curves, establishing a new currency price. In this simplistic example, the quantity remains constant, but that is not obligatory for the real-life situation. Productivity is a leading national characteristic determining competitive power globally. It moves to the fore when other inputs to production remain constant, increasing domestic output as a result of maturing industrial techniques and established workforces. In highly developed economies, the productivity factor extends well beyond manufacturing sectors to include technology, services, and other spheres of a national economy. In this example, we will look into an increase in productivity in the US while UK productivity remains constant. When exported to the UK, US goods become less expensive as compared to UK goods. Product demand increases, causing an increase in the supply of pounds, a supply curve shift to the right. Also, the US demand for UK goods drops. The demand for pounds will decrease, causing a shift to the left of the demand curve for pounds. The result is an appreciation of the US dollar as compared to the British pound, and the currency changes from $1.50 to $1.40 per pound. Again, the shift in value was seen with no change to volume. Country of origin preferences may be the result of effective marketing efforts, or consumer choice of better designed products, or perceptions about differences in quality, or because consumers seek just plain good deals. Assume U.S. consumers develop a stronger demand for UK-produced goods. Because of the stronger demand, U.S. imports demand more pounds to purchase their products. The demand for pounds shifts to the right, causing a new equilibrium between price and quantity to establish. Interestingly, an increased demand for a country's exports causes its currency to appreciate in the long run, while increased demand for imports results in the devaluation of the domestic currency. We have earlier investigated barriers to trade between countries that serve to modify the demand for foreign products by creating an increased demand for domestic import competing products on a cost basis. The effect of those barriers on currency values becomes obvious with a decrease in consumption of imported goods as they enter the domestic market. Since the demand for the foreign-made goods decreases, it also decreases demand for British pounds, causing a shift to the left of the demand curve and a new equilibrium price and quantity established for dollars per pound in the international currency market. In this situation, the US dollar appreciates from the $1.50 to $1.45 per pound, while the quantity decreases from 6 to 5 million pounds. Trade barriers generally cause currency appreciation in the long run for the country imposing the trade barriers.
Many economists believe exchange rates should eventually adjust to make the price of a basket of goods the same in each country. But the average basket of goods in America is different from the average basket in China. To overcome this problem, The Economist introduced the Big Mac Index in 1986, because apart from a few exceptions, the Big Mac has the same ingredient worldwide. Comparing the price of the Big Mac in different countries, we can see which countries' currencies are currently under or overvalued. But the theory does have some flaws. While sesame seeds might be cheaper in China, the cost of transporting them to America might eliminate any profits. And there are import taxes too. It's not just the ingredients that matter. The price of labor and rent is different from country to country. And even if you can import all the goods, unless you're McDonald's, you can't sell Big Macs. So what can you use the Big Mac Index for? If you're an economist, it still gives some indication how exchange rates will move in the long run. If you're a consumer, it gives you a rough idea of prices in other countries and how far your money will go. And if you're really into Big Macs, it's your travel guide.
In Chapter 11, we introduced purchasing power parity in the context of real and nominal exchange rates. By combining those ideas with inflation rates existing in between national currencies and price forecasting, we will find extended applications to this concept. Purchasing power parity involves the effects of arbitrage and also the existing economic reality that consumers, where possible, will seek lower prices for identical goods in adjacent markets, and more directly within a single market. Taken to the next level, consumers will seek comparable goods, with price adjustments, in nearest neighbor markets, or shipping from adjusted markets, all seek the lowest adjusted price for goods. Sellers use the same strategies as they seek the highest price to sell their goods, with similar distance-adjusted factors. Again, the uniqueness of currency as a commodity plays into these discussions as a topic of most interest. The law of one price asserts that identical goods in different markets will sell for identical currency-adjusted prices. Producers seek misaligned markets by locating where their product families are not in sync with the purchasing power parity, signaling an opportunity for market development in the foreign land. A bit of a misnomer, the law of one price has no official police enforcement squad. Prices will normalize within economic realities of profitable decision-making. Barriers to trade, shipping expenses, and country of origin concepts can easily erase arbitrage efforts. The McDonald's Big Mac example delivers this message nicely and illustrates another measure of cross-country price arbitrage: consumer tastes. We explored purchasing power parity as a tool to explain how prices of goods within countries serve to direct currency exchange rates. In the long run, currency exchange rates normalize to make the cost of goods and services level out across countries. We can explore the example of a US and Japan trade of steel as an indicator of the relative currency exchange rates, illustrating how the concept is applied to one product in two countries. The example illustrates how changes in product prices indicate a change in the currency through cross-currency exchange rates, as appreciating or depreciating in relation to each other. Economists recognize the characteristics of these changes, but we are more interested in economy-wide price migrations in more than 2 countries. In the U.S., the Bureau of Labor Statistics, the BLS, manages the longest-running database of monthly price indices, called the Consumer Price Index and the Producer Price Index, the CPI and the PPI. These provide users with an inflation indicator of the U.S. within each sector of the economy, one for consumers and one for producers. These indices give users the ability to convert a series of nominal prices into real prices, with inflation removed. This allows analysts to make cross-sector comparisons of price differentials, while extending the nation's real price migration cycles to other nations. The BLS maintains equivalent indices for our major trading partners, based on the products from those countries as they are imported into the U.S. Of highest interest to economists is the relative inflationary differences between one economy and another, and how they interact. Inflationary differentials will instigate commodity price competition between products from different nations, a change in demand and supply for cross-currency trades. Ultimately, exports and imports of goods and services constitute a mechanism that makes a currency depreciate or appreciate, according to the Purchasing-Power-Parity theory. The linkages identified within price indices between nations establish the connection between commodity prices and currency prices, giving a method for measuring comparative inflation rates and therefore currency exchange rates. We take a look at price indices of the US and Switzerland using the variable seen here. The Purchasing-Power-Parity theory directs us to create a ratio of the change in US prices over a set period of time, divided by the ratio of prices in Switzerland for the same period, multiplied by an equilibrium exchange rate on the base period. In this example, we can pull data from sources such as the BLS and currency exchange rates from Forex to establish a simplistic prediction of long-run exchange rates. In this example, we see U.S. prices climbing by a factor of 100%, a result of inflation, while prices in Switzerland remain constant. We have a current exchange rate of 50 cents per Swiss franc. Putting the numbers through the formula, we see that the future exchange rate is expected to migrate to $1 per Swiss franc. The US dollar depreciates. This is an easy migration calculation given the variables used, but in practice, you would process your estimates with different variables and would forecast both P1 and S1 to predict what the future exchange rates would be. This is an interesting exercise to participate in, but it fails to incorporate all of the factors affecting currency exchange rates, such as trade barriers or new entrants to commodity or service markets. Of course, of critical importance becomes selecting indicator goods to serve as a cross-economy's salesman. Indices such as the PPI from the BLS are good starting points for U.S. analysts, but locating identical index measurements for trading partners can be difficult. In the short run, these estimates prove to be weak, but their utility improves as projections are extended into the future. Of course, the further out in time the projections are made, the higher the probability that political effects will influence the results, or that technological changes will alter prices. We see an example of the US and England from 1973 to 2003, where the UK price level increased about 99% as opposed to the US price level. Following the Purchasing-Power-Parity theory logic, the pound depreciated against the dollar, but only by about 73%, less than the PPP theory predicted. Other factors were at play when determining supply and demand for currency exchange and price predictions. While studying this chart, it becomes evident to us that PPP theory is not explicitly useful for the short run, but it can provide long-run trend forecasting. Additional factors must be integrated into accurate predictive models, accounting for price level behavior, productivity trends, technological advances, country of origin preferences, or barriers to trade. The asset market approach may be one of those additional factors needed to increase forecasting accuracy. Currency exchange was initially established for companies in different countries using different currencies, making currency trade a key component of international trade. In those early days of trading, there were no computer networks, telephones, or even speedy land mail systems. It was done in person, often at the dock. Today, as I have mentioned earlier, currency trading has evolved into a level of trading commensurate with a commodity. In fact, the daily trading in currencies through the largest trading network in the world is completed by investors in assets such as treasury securities, corporate bonds, bank accounts, stocks, and real property, making up about 98% of all trades. The remaining 2% of trades involves commodity exchange, the initial nexus of international currency trading. During short periods of time, decisions made to the effect of which kind of assets it is more important to hold, domestic or foreign, play a much greater role in exchange rate determination than demand for imports and exports does. According to the asset market approach, investors consider two key variables when deciding between domestic and foreign investments. First, the relative interest rate levels, and second, expected changes in exchange rates over the term of the investment forecast. These factors are attuned to the short-run forecast scenario, giving it an increased advantage for that purpose. This summary table demonstrates some of the factors comparing the US and UK for a short-term investment horizon. These are casual responses, but be prepared to apply changing values to these factors as they are applied to your industry. Because investors are the primary players on the field of currency exchange, understanding investment decisions for this sector will help to explain how decisions are made and executed. The rate of return for an investment begins with the establishment of the nominal interest rate on an investment within different investment countries. This approach is like chasing a rabbit to seek where high rates of return have been captured in the past. Others will seek the emerging markets sporting similar characteristics. As these lands of opportunity are identified and investments are made, the international flow of money will increase and currency valuation migrations will be realized from the less demanded to the higher demanded currencies. Currency appreciation and devaluation will ensue, and economies will adjust to the changing reality. We have walked through charts like these while addressing other migrations of prices, interest rates, supply and demand. I invite you to track the shifts of supply and demand curves on these charts, understanding that these curves shift to the left and shift to the right, identifying new equilibrium price and quantity solutions. They are all in the textbook, so study them and develop your personal understanding and how you will think like an economist. Investment rates of return, inflationary forces, and predictions of the rising stars of international investments are considered strong factors when making investment decisions. There are other factors, sometimes less important and sometimes of great importance. Because of the substantial amount of corporate investors in the currency market and the investment profession, caution is given to over-concentration in one investment class or one region. Decisions involve choices for commodity over-intensification and country concentration. Attention is given to diversification of investment exposure by spreading sectors of investment into different classes. In a similar mode, decisions are made to diversify investment countries not to put too much reliance on one country's rates of return. Conversely, safe haven effect emphasizes confidence on investments in countries with reliable track record of performance that overrides lower estimated rates of return. These decisions are made on an investment-by-investment basis, with generalities and specifics investigated and understood.
In the day's other news, Federal Reserve Board Chair Janet Yellen affirmed that short-term interest rates are likely to rise again in the coming months. But she also left the door open to changing those plans. Yellen told a congressional hearing that a recent slowdown in inflation might make the central bank recalculate.
Monetary policy is not on a preset course. We're watching this very closely and stand ready to adjust our policy if it appears that the inflation undershoot will be persistent.
Separately, Yellen said the Fed could begin to unload its massive bond holdings this year. It bought government bonds during and after the recession in order to lower long-term interest rates and to boost economic activity. Wall Street took heart from Yellen's talk of going slow on rate hikes. The Dow Jones Industrial Average gained 123 points to close at 21,532. That's a new record. The Nasdaq rose nearly 68 points, and the S&P 500 added 17.
Since early 2014, business news consumers have listened to the U.S. Federal Reserve Chairman, Dr. Janet Yellen, make announcements about the Fed's decision to raise interest rates soon. These announcements, as they are delivered, have immediate impacts on the stock market, interest rates, exchange rates, and investment portfolios as investors react to this news with emotions. Frequent changes in policy or warnings of changes leading to unfavorable conditions contribute to the volatile exchange rate responses. In reaction to these policy-related statements, investment patterns migrate to anticipated safe havens or to reduced risk investments. The volatility of international exchange rates is intensified by the phenomenon of overshooting, when the short-term response to a change in the macroeconomic fundamentals is greater than its observed long-term reality. As we sit in late 2017, a new Federal Reserve Chairman nomination for Jerome Powell is being promoted by the White House. This brings with it an entire slate of new Federal Reserve realities to ponder. The phenomenon of overshooting will be mitigated across the realm of forecasters and forecasts.
Thank you very much. Please. I'm pleased to welcome members of the Cabinet, members of Congress, and distinguished guests to the White House Rose Garden this afternoon. Also, I want to welcome the Chairman of the Senate Banking Committee, who's done an incredible job, Mike Crapo. Where's Mike? Please, Mike. Great job. Appreciate it. As president, there are a few decisions more important than nominating leaders of integrity and good judgment to hold trusted positions in public office. And few of those trusted positions are more important than the chairman of the Federal Reserve. Accordingly, it is my pleasure and my honor to announce my nomination of Jerome Powell to be the next chairman of the Federal Reserve. Congratulations, Jay.
Thank you, Mr. President.
We explore rate overshooting in terms of overshooting elasticity effects in the short run versus the long run. The short-run supply and demand schedules of the UK pound are explored. We find the supply and demand line intersection with equilibrium quantity at 60 billion pounds at a price of $2 per pound in the short run. If the demand for pounds increases to D1, the US dollar depreciates to $2.20 per pound, again in the short run. This devaluation of the US dollar leads to the UK price of US exports to decrease. The US exports to the UK increases, and thus the quantity of pounds supplied to the US economy increases through the foreign trade effect. As more time elapses, the quantity of export grows, and the rise in the quantity of pounds supplied to purchase U.S. goods increases. The long-run supply schedule of pounds is more elastic than the short-run supply schedule, as shown here with the easing of the elasticity of supply. Following the increase in demand for pounds to D1, the long-run equilibrium exchange rate is $2.10 per pound for 150 billion pounds, as compared to the short-run price of $2.20 per pound. Because of the effect of price elasticities, the dollar's depreciation in the short run overshoots its long-run depreciation results. Creating reliable forecasts of exchange rates involves extensive market research, constant attention to market forces, solid economic judgments, and a ton of good luck. Nevertheless, short-term exchange rate forecasts are desired by exporters, importers, investors, bankers, foreign exchange dealers, and the forecasting economist wanting to do it right. A global industry has been formed to make these projections, sometimes made public and very often held confidentially by the clients paying for the projections. Econometric modeling combined with statistical analyses and economic projection formulas are combined to create forecasts of short-term to long-term projections, tempered by heuristic adjustments to prepare them for the final client's use. Two levels of understanding are required, one for the analyst and the other for the user of the data. Very often, a drastic prognostication of future events may not be anticipated by most, while a small group or even a single analyst will make the projection, understanding current economic variables and the anticipated results. Investment advisors using the data cannot simply trust the analyst with their clients' hard-earned money. They need to understand it as well. Several forecasting organizations have emerged in the US and abroad. Their growth potential is based on their record of achievements in good and bad economic times. Forecasters tend to develop techniques to achieve a reputation of knowing their sector, country of experience, or even the time periods they are best accustomed to project. One of the forecaster types recognized in the industry is a judgmental forecaster, who becomes known as the Russian expert, or the China wonk, or the specialist knowing how and when forces in a target country will emerge as a currency investment factor. Their resources will reach into political and economic realms, knowing not only the interactions of the US and the targeted country, but also the target country's interactions with other trading partners. The judgmental forecaster is known for having a feel of the market. Often called the history repeats itself forecast, technical forecast estimates are best applied in the short-term horizon and can extend only as long as predicted patterns remain in force. When initiation criteria in the current situation match past conditions, the technical forecasting econometrician will make predictions based on past performance with adjustments for current circumstances. Fundamental analyses use a plethora of economic data accumulated for countries, currencies, commodities, labor employment, productivity, and inflation rates in their domestic economy and other countries to create econometric models showing past response patterns for supply and demand, fitted to current economic conditions. Because of the complexity involved, several forecast submodels may be created, each feeding into the forecast model. These econometric models are best known for the realm of the long-run forecasting, but short and mid-range estimates are achievable. They are just much more difficult to achieve. Currency traders generally prefer technical analysis over fundamental analysis when forming a trading strategy. Still, most forecasters use a combination of fundamental, technical, and judgmental analyses when making their projections. Conditions are best when all three techniques agree about the recommended response for investments. But really, that is seldom the case. At the critical time for action, when a decision needs to be executed, it is based on the chief analyst's best arrangement of the data provided. Currency movement across nations has been investigated as we looked at factors of market fundamentals and market expectations. We explored the determinants of exchange rate fluctuations as being different in the short run and long run. Exchange rate overshooting can persist for significant periods of time, while fundamental forces tend to push the currency back to its long-run equilibrium path. We considered how exchange rates are determined in the long run, and how the long-run determinants of exchange rates include relative productivity levels, relative price levels, consumer preferences for domestic or foreign goods, and trade barriers such as tariffs and quotas. We examined how the purchasing power parity approach determines changes in relative exchange rate price levels over the long run. Currency maintains its purchasing power parity if it depreciates by an amount equal to the excess of domestic inflation over foreign inflation. In the short run, decisions whether to hold domestic or foreign assets hold a primary role in the exchange rate determination, as investors consider two key factors when deciding between domestic and foreign investments: relative interest rates and expected changes in exchange rates. Changes in these factors result in fluctuations in exchange rates that we observe in the short run. We also looked at the phenomenon of exchange rate overshooting. An exchange rate is said to overshoot when its short-run response to a change in market fundamentals is greater than its long-run response. Finally, we wrapped up this chapter to consider the methods that currency forecasters use to predict exchange rate movements as being judgmental forecasts, technical analysis, and fundamental analysis.